Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Ben Jones, Product Development Specialist with Nasdaq Index Research, to discuss if interest rates have hit a bottom and fixed income performance. Ben, welcome to Trade Talks. And that really is the million-dollar question when it comes to interest rates. Have we seen the bottom? What does your first chart indicate?
Yeah, so if we look at basically U.S. 10-year Treasury note yields, you can see that it has been forming a little bottom there. If you look at this chart, you can see how it's coming out of those lows in the low 0.5s, and it's really was consolidating around there right after kind of we hit the middle of, let's say, the COVID-19 pandemic, let's say, in the summertime, right? So we are working off a bottom, and this could end what really has been a 3-year trend where we've seen interest rates really move off of those, I guess you can't call them highs, but the late teen highs for the 10-year yield. And this is, maybe not a million-dollar question, but a multi-billion-dollar question is what's going to happen with fixed income, what's going to happen with bond prices, and more importantly for advisors and investors listening out there, it's, what are you going to do, right? We know that if we do see interest rates rise, that is certainly going to be a headwind for fixed income prices, right? Because we know bond prices move inverse to interest rates. So this is something that we're watching because you have seen a move off of a low, and this really started to accelerate after the presidential election.
And Ben, tell us about the Dorsey Wright Fixed Income Allocation Index.
Yeah, so this is an index that is based off of a Dorsey Wright model strategy, and it's an index that is used to provide a way to track a tactical relative strength-based strategy for navigating the fixed income market. So if you think about this index, basically what it does, it applies the Dorsey Wright relative strength methodology to a universe of SPDR fixed income ETFs. And every week they rank these ETFs by their relative strength. So those, let's say fixed income sectors that are exhibiting momentum and positive relative strength will be at the top. Those areas that are exhibiting weakness are going to be at the bottom. And so they identify leaders by focusing on those areas that are working, that have positive relative strength. This is important because if you look on the left-hand side, this is the inventory which the index pulls from. You see a wide array of different sectors represented. So those areas that tend to do well when interest rates fall, right? So think your classic, long-term treasuries, U.S. treasuries, intermediate bonds, et cetera. And also areas that, tend to behave a little bit differently to, let's say, the yield. So if interest rates rise, those areas that might participate in a different way, those areas that are insulated, think high yield bonds, convertible bonds, floating rate, and even diversifiers like emerging market local currency bonds. So it pulls from this inventory and basically it selects the 4 strongest fixed income sectors. So if we look at the index today, you can see that it's positioned towards areas that tend to have, low correlations to interest rates, areas that tend to be more equity-like and not as sensitive to interest rate movements. So think, corporate bonds or preferred stock. There's no treasury exposure in this index right now. So you can definitely see it's positioned away from those areas that are really sensitive to a rise in interest rates.
And Ben, how about the performance over the past year?
Yeah, so it responded well, right? We saw a lot of volatility within the fixed income asset class at the height of the COVID-19 pandemic. So the height of really that market correction, right? So think, the middle to latter part of March. But the index has responded, right? As the index begins to shift towards areas that are more equity-like, right? So we saw a rotation into convertible bonds at the end of May. We saw a position of international corporate bonds go in there in early September. It started to really perform well and actually outperformed the aggregate bond index last year. The global aggregate bond index last year. So the strategy is up about 14% on a 1-year roll compared to about 8.3%. So it's done well over the last 12 months. And so I think what's important though, Jill, is that it does adapt, right? So all of a sudden, if we see this like short-term bounce and interest rates falter and interest rates start to move lower again, the index will adjust, right? Because those areas like, let's say U.S. treasuries might begin to outperform. So you can see the strategy adapt. I think that's what's important going forward is that we can't predict the direction of interest rates. So we need to have strategies or we need to have indexes that allow us to adapt and participate in these trends. And, this is what this, fixed income allocation index is designed to do.
All right, Ben, appreciate the update. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.